John, I feel like it's a race to the bottom, and I'm not exactly sure whether that race to the bottom will only end if the U.S. Treasury intervene in the money markets. I mean, you know, psychologically, people are talking about that now.
They are talking about it. I think the race to the bottom ends when the trade war ends, because all of these rate cuts are coming in response to the stress that tariffs are creating. It's an interesting sort of two-tier race, because obviously the Fed is not interested in pursuing this quick path down in policy rates, and the comments from Bullard overnight, where he talked about how the Fed doesn't need to respond to every threat around tariffs, is an interesting sort of contrast to the way other central banks are really much faster out of the blocks in terms of responding.
Okay, what does it mean for when you look at yield? I mean, if you look at bond yields, do they just go ever lower? And again, what's the pain threshold there?
It's to me, there's a directional consequence, which is lower yields, but there's also this curve consequence that Tom alluded to earlier. Part of the reason the U.S. curve is flattening in this way is this belief that the Fed is not going to respond to every tariff threat by cutting the Fed funds rate, and therefore they risk a policy mistake where the economy just slides from above trend growth to below trend, possibly into recession, and that's what's causing the curve to flatten.
John, I want to congratulate your firm on very nuanced notes over the last 3 days. They've been a real joy to read, and the phrase that sticks out to me is your comment on, quote, Trump's math, unquote. What is the calculus that the president studied at Wharton? What is the calculus he gets wrong right now?
I don't know if he studied it or he just sort of made it up on the fly, but I think his arithmetic essentially implies that if he hikes tariffs and the Fed cuts rates, then growth is going to remain stable at an above trend rate, and asset markets are going to be stable at very high levels. And I think that calculation is completely off. I think what we're learning is that as tariffs go up, there's a ratcheting down in corporate confidence and corporate spending. And it's not clear to me that these Fed cuts are going to provide any kind of relief in the near term. So I guess his risk is that even though the Fed might restore growth eventually, maybe it's early 2020, if growth doesn't return in the next 6 months, you can obviously see a deeper correction lower in equities and a correction wider in spreads.
John Norman,
so a calibration issue around this.